Good afternoon, everyone. We'll just give a few moments to allow more people to join us before we get started, but thank you very much for making time this afternoon. Thank you, everybody. Good afternoon. My name is Craig Evans, and I'm Head of Economic Policy here at the Australian Banking Association. And I'd like to thank you all for joining us this afternoon for our ABA Economics webinar series. This is a series exclusively for ABA members and stakeholders. And today we commence our webinar by acknowledging the traditional owners of the lands on which we meet, and I pay my respects to their elders past and present. For us at the ABA, we are located on the traditional lands of the Gadigal people of the Eora Nation. So the session today will be a panel discussion centered around the topic of managing liquidity risk in an uncertain and volatile world. And we will cover how banks are responding to some of the increased volatility caused by events like the run on Silicon Valley Bank in 2023, and as well as the strains on long-standing international trading and financial relationships that have been caused by recent global tensions and have perhaps undermined some of the long-standing relationships that financial markets and financial market players could rely on. While Australian banks have a higher shares of domestic funding than some of our global peers, they are still impacted by this volatility and need to react through funding diversification, strengthening liquid asset buffers, and developing real-world stress scenarios. We'll also explore emerging trends such as tighter regulatory oversight and the growing role of AI in forecasting. Today, I have the genuine pleasure of introducing our panel of experts, each bringing deep experience and unique perspectives on how banks and the industry are navigating the evolving landscape of liquidity risk. Today, we are joined by Ian Pereira, Managing Director of PwC. Ian is an experienced risk professional who has 15 years of experience working with Australia and UK banks, most recently helping them navigate liquidity, regulatory reporting requirements, and an increasing demand for timely, accurate information in decision-making. We are also joined by Amber Curry, who is Head of Treasury Operations at Bendigo and Adelaide Bank. Amber is a multidisciplined risk leader with deep expertise across liquidity, credit, operational, and compliance risk management, and brings over 25 years of experience in the financial services sector and has spent the last decade specializing in treasury operations. And finally, we are also joined by David Waller, Head of Funding Execution at CBA. And David has 25 years of experience in banking, including over 15 years in various treasury roles at CBA. He brings deep expertise in balance sheet management and liquidity, and in his current role leads the global strategy and execution for both long and short-term wholesale funding and liquidity management for the group. So before we begin, I would also note that there will be an opportunity for following the panel discussion for some questions. And so please feel free to send any questions that you may have during the discussion by using the Q&A tab that you might see at the top of your screen. But to kick us off and to kind of frame and open our discussion, I might begin by asking Ian, why are regulators, both globally but also domestically through APRA, so focused on liquidity risk right now? Why is it so important a policy challenge in the current geopolitical climate?
Thanks, Craig. So I think regulators have been focused on liquidity risk for some time now, and especially so off the back of the more recent banking failures in 2023. What we observed, there are many things to be observed from those banking failures, but one of the observations to be made is that whilst the impacted banks had various root causes to their failures, some rooted in mismanagement of interest rate risk, some rooted in operational risk and regulatory risk type aspects. The common kind of string which connected them were that those sometimes distinct events translated into a crisis of confidence, which then translated into liquidity events individually. Since then, I guess there's been a little bit of a greater awareness of the fact that liquidity events can manifest in different ways. And there is some skepticism as to where the next, when and where the next liquidity event could take root. Geopolitical risk is only but one flavor of how those liquidity risk events could play out. It is especially topical in recent times, just given the once established and trusted relationships and mutual support mechanisms that we have grown to rely on have now been called to question.
Thank you very much, Ian. And David, I suppose CBA is an internationally active large bank. So how do you think about liquidity management and how does the global environment impact how you think about it?
Yeah, thank you, Craig. I certainly think there's two lenses that you can look through the liquidity positions of any bank, and CBA has a liquidity position of close to $185 billion. And I think the first lens that you can use is a regulatory lens and the regulatory requirement around us having that liquid asset stack, but also really from a liquidity practitioner's point of view, which I am, is kind of the BAU and how we kind of make sure that stack is actually fit for purpose on any given day. The regulatory amount is very much a function of APRA's requirement around APS 210 and the LCR requirement around our 30-day liquidity needs. If we add on to that the stress testing that we undertake domestically as a bank, be that looking at domestic idiosyncratic stresses, global market stresses, the LCR number that we come up with is very much around meeting that obligation around a stress testing under that 30-day kind of premise and above. Practically, however, the second lens that you can use is very much around making sure that we've actually got cash in the right places, in the right time zones, to meet our obligations as they fall due. Practically, CBA, we move currencies. We have over 23 currencies that we're active in. Clearly, Aussie dollars is our main currencies, and when we're a self-clearing Aussie dollars, we have a large ESA balance and we have a large HQLA balance in Australian dollars. So Australian liquidity isn't a huge concern per se for us, given that large stack that we have. However, when we look at the currencies where we're active, and other currencies really being US dollars, euros, sterling, and yen, we've got large customer and proprietary flows that occur in those time zones. So having an HQLA stack is useful, but clearly having an HQLA stack that can meet those liquidity requirements in those global time zones on a BAU perspective is absolutely vital. There's little value having AUD on our domestic sheet here if we have a liquidity event in the London time zone in sterling. And that's particularly true, as Ian alluded to, the fact with the likes and the speed of the events that we've seen, given the SBV failures and the like, that these events can happen in time zones around the clock, and can catch you unawares in certain currencies. So the LCR stack and the regulatory requirement is certainly one lens, but actually the practical and the mobilization to avoid trapped liquidity is certainly kind of something that we do a lot of time at CBA on.
Thank you very much, David. And that's obviously the challenge that you're talking about, having exposures in different time zones and different currencies. Amber, just going to you now. Bendigo is a regional bank with a stronger domestic focus. How are the challenges of liquidity management kind of different for an organisation your size?
Thanks, Craig. So managing liquidity risk is important for banks of all sizes and balance sheet composition, as it's a known cause of bank failure. And as Ian, you mentioned earlier, while most bank failures will generally be the result of some other cause, liquidity issues will be what actually cause the bank to fail. So in comparison to CBA, our balance sheet is approximately $100 billion. So that is a much smaller balance sheet and largely domestically focused in the Australian geography. And whilst our balance sheets are different in size, our approach to managing liquidity risk is largely consistent with CBA or with any of the other large banks in Australia. So I was just going to spend some time talking around two key focus areas. What we focus on is firstly the management and assessment of liquidity risk and the importance of wholesale funding, which I'll come to a little bit later. So for the next few moments, I'll talk around how we manage and think about liquidity risk. So firstly, it's important that we have an experienced team comprising of good people who know how to manage and who are actively monitoring liquidity risk continuously. And then how do we monitor liquidity risk? So on a daily basis, we calculate the liquidity coverage ratio and we monitor that against our risk appetite. So the LCR, as you were talking to there, David, was a post-GFC reform designed to prevent failures by requiring banks to maintain emergency funds over a 30-day horizon. We also calculate the net stable funding ratio, and that has been in place for approximately 10 years, and that was a metric designed to promote resilience over the longer term horizon than the LCR by requiring banks to be funded by those stable sources of funding on an ongoing basis. In addition to this, we monitor a range of liquidity metrics against risk appetite, and risk appetite is set at both the board and management level, and we have escalation triggers in place for if and when required. We also have a range of early warning indicators with defined escalation triggers to management that we monitor again on a daily basis. There's a lot of daily monitoring that does occur, and then at least annually we'll review all these metrics and the risk appetite to ensure that they remain appropriate. We're also monitoring balance sheet movements, intraday flows, and the results of our liquidity stress tests, which David, you were talking around stress testing too. Some of the other areas of liquidity management that we focus on is annually we develop a funding plan, which looks at how the business plans to evolve, and then we develop a plan in Treasury of how we'll fund that. And the APS 210 requires us to do over a 3-year horizon. So we do that for 3 years. And that funding plan, it's that balance of managing liquidity risk against performance, because holding too much liquid assets can weigh on your returns. Yet if you don't have enough buffers, it elevates your risks. So managing it is a strategic trade-off. And then we have, so I've still got a couple of things I'll talk to there, Craig,
Please.
is the stress test. So post Silicon Valley Bank crisis of 2023, there has been significant focus across industry on improving banks' approach to liquidity stress testing. For us specifically, over the past 18 months, we have completely redesigned our approach to liquidity stress testing. And I'll provide just some high-level detail on how we do stress our portfolio. So we started with setting the risk appetite for liquidity and what we are protecting, and we had that set by the board. We then developed a range of stress scenarios over various durations and severity, from quick burn, which is 1 month, to 12-month scenarios for various severities, from moderate to severe severity. As we developed these scenarios, we reviewed a significant amount of literature about historical bank failures globally and how their balance sheet reacted at those different stresses over the past, over time. And so we've then developed assumptions in our stress tests about how the balance sheet did respond to those events. So we looked at both external, internal information, as well as we relied on subject matter expertise. Through this stress testing, we also developed additional metrics to monitor liquidity risk, such as the survival horizon. We now run our liquidity stress tests on a monthly basis using daily increments. So it just shows how your balance sheet, or how your we put it back into an LCR metric, how that performs over time. And the results of those stress tests are used to inform our risk appetite, our contingency funding plan, and also our funding plan.
Right. Well, thank you so much, Amber, for that. I suppose just a few follow-up questions to people here. So, David, I suppose one question I would have is, you're having to think about all of your global operations in different currencies around the world, but you also have to think about, how you can fund that, but also what alternatives there are to your existing funding. And, are you considering, new or alternative funding sources that go beyond your traditional channels, given the volatility in the global environment? And, how do you assess how reliable those channels are?
Yeah, listen, I actually think there's been, again, a huge change and a huge development in the way that banks are managing their liquidity from times gone past. I mean, we certainly highly consider our mix of liquid assets that make up the high quality liquid assets, or HQLAs, under the stack. I mean, clearly, the majority of our operations are in Australian dollars, and therefore a lot of our HQLA assets are Australian denominated. But we need to make sure that we do have instant liquidity effectively in those time zones that I was talking about. So when we think about New York and our New York operations and our London operations, we need to make sure that we've sized our cash buffers in those jurisdictions to be appropriate to the liquidity events that we may consider, both under a BAU and the stress scenarios. So we do have a concept of day one liquidity and instant liquidity, and be conscious of time zones and where they sit. Clearly, the problem with Australia being at the beginning of the day, by the time we go home, the rest of the world is still very much open and active. I think banks have been increasingly comfortable over time recognising that day one or instant liquidity, which effectively gets met, that requirement gets met by using cash as a liquid asset. I think traditionally, in times gone past, banks would be very much conscious that the HQLA stack would be a costly exercise, as Amber suggested. The more liquidity that we hold as a bank, the more effectively drag that has on the bank's overall performance. So there is a trade-off between how much liquidity a bank needs and how much they're prepared to pay, or foregone cost of alternative assets. But I think that there has been a recognition that cash is an important part of the liquid stack and shouldn't be neglected. And I certainly think that central banks have realised that and helped. Certainly the movement from the RBA that we saw during COVID, in which they increased the amount of the ESA funds, that the interest received by banks on ESA funds, effectively made holding cash in Australia a genuine and equitable holdings of HQLAs. So that certainly assisted and recognised the importance of cash. I think when I talk about offshores, as again, I just try to be somewhat different in my take to Amber's. But when I think about how we think about our offshore currency mixes and the like, where CBA and Australian banks would manage their own liquidity in their own currency and self-clear in their own currencies, when it comes to foreign currencies, traditionally banks have outsourced that liquidity somewhat to their nostro providers or correspondent banking relationships. And traditionally, we've relied really upon the unadvised, uncommitted liquidity provided by those correspondent banks. Now, when we roll through today, that clearly isn't a prudent strategy going forward. Just to rely on the goodwill of our clearing banks as well, and especially in the likes of the political uncertainty that we've been talking about. So again, understanding where those cash needs to be and where those liquidity positions could come from has become adamant, become so important for us as a group. We've spent a lot of time actively in understanding and monitoring both our own liquidity positions, but also intraday liquidity positions in foreign currencies. And again, that's something that's quite new for an Australian bank. So we'd like to know and actively see where our currencies are in any given time, and have the staff in locations to be able to kind of liquidate and move that cash around when it needs to be done. It's been interesting to see that central banks have also made it clear that of times gone by, central banks were very much seen as a lender for last resort for liquidity management. There was always a huge stigma that if a bank had to go to a central bank for assistance, both in Australia and offshore, that came with effectively a view that you'd poorly mismanaged or misunderstood your liquidity requirements, and banks have been very loath to do that in the past. I think it's become quite clear that central banks have made themselves open and actively encourage banks to make sure that they have the capacity to use their windows, and certainly actively removing the stigma. And we've seen that from the RBA and from the Bank of England only in the last 6 months. That's highly welcome, clearly, from a liquidity practitioner such as myself, that those facilities are there to be used. We at CBA would actively test our facilities that we have open to us at both the RBA, the Bank of England, and the US Federal Reserve. From a funding perspective, if we move away from liquidity but more to funding, and how does funding look in uncertain times? Part of our funding strategy at CBA is to maintain a diverse source of funding, both in short-term markets and in long-term markets. That's diverse in terms of products, currencies, and jurisdictions that we can funding. We have the ability to issue securitized in securitized formats. So using covered bonds and RMBS is a way of effectively, in market volatility, we believe there's still capacity, there's still market appetite for those higher effectively rated securities that we can issue under those programs. We've also got a modest short-term funding footprint for a bank of our size, and believe that our good credit rating for CBA gives us access to money markets in both secured and unsecured markets should we need. So for us, it's about having that visibility of our position, understanding the mobility of our cash positions, but also understanding how we can raise funding very quickly in times of stress. And I'm sure it'd be the same with Amber. We definitely have a series of effectively, we undertake that as a stress testing exercise at least annually at CBA. We also have a series of effectively playbooks and stress scenarios in which we would go to in such an event of a crisis.
Thanks very much, David. I suppose, Amber, just to follow up on some of the points that David raised, I mean, one of the things he did touch on is just, the kind of evolution that we've seen in recent years. There's been a lot of developments that have happened. Has that kind of, have your view about what the risks are to managing liquidity, have they changed significantly in recent years? And is there something, have you taken, different steps because of that?
Thanks, Craig. So I spent a bit of time earlier talking around how we think about liquidity risk. What I thought I might do now in answering your question is just talking a bit more about that wholesale funding, and is that important consideration for liquidity management. And just for us at Bendigo, the strength of our customer deposit franchise reduces our reliance on the wholesale markets and supports a resilient and stable liquidity profile. So quite different to but what David experiences there. On our customer deposit side at Bendigo, our customer deposits make up about 77% of our customer of our balance sheet. Or if we look at it and a slightly different metric, 73% of our household loans are funded by household deposits, which is significantly higher than the major bank average, which is around 63%. Although I think the second CBA is closely behind us compared to an ANZ or a Westpac. And so, yes, whilst on the wholesale funding markets, whilst there are times of volatility, right now the markets are actually really favourable, and there's a lot of investor money out there, which has been consistent for the past 18 months. And I read something last night where an analyst was saying that these are some of the absolute best primary issuance conditions we've ever experienced in the Aussie market. And given the strength of that market right now and our funding plan, we at Bendigo, our funding needs are well within our capacity. And David, maybe if I could just hand over to you, because this is more in your field of expertise than me. What are you thinking around why there is so much money in the market, and particularly given your recent large issuance? Did you have an order book of somewhere near like 14 billion, which was a record for the Aussie market? And was that a week ago?
Yep, that was only, it seems like a week ago. It was less than it was last week. But yes, you're right. We came to market with an Australian deal last week, and we issued $5 billion of a senior tranche, and we soon followed that up that evening with a euro issuance for CBA. So you're right. The demand for Australian credit has been large, but that's true of global credit across the board. So you're right, and credit spreads continue to be favourable, even in times when we've seen volatility such as the Trump tariff announcements and the like. There has been a spike in credit post those positions, but they've quickly reverted back to levels and kind of continue to go on. So the market does seem very, I wouldn't say dismissive, but certainly quick to return back to credit positions and market favourability for bank credit quite quickly. In answer to where that money's coming from and how quickly that money comes and where that's come, that's an interesting point. We've certainly seen probably a propensity for investors for fixed income products, which is probably, my personal view of that, certainly in Australia, from an Australian sense. Clearly we have an aging population and a baby boomer population which is moving close to retirement. So as a consequence, there's people moving their superannuation funds into more fixed income and safer assets and equities. So that's been a part of the play there. But when we also issue in Aussie dollars, there is a huge amount of appetite coming offshore for that product as well. So there is a big Asia demand for Australian paper generally, but also when we issue in Aussie dollars. And that's part of the dynamics that we've seen in Asia, where we've seen effectively the China story and the China slow down somewhat. So a lot of money that was invested in the China mainland has found its way in alternative assets.
It looks like we've lost in there, Craig, for a moment, so maybe I'll come back.
Yeah, he might come back in a moment. So perhaps I might just take this opportunity to bring Ian in the sense that we've heard kind of the experience of individual institutions of CBA and Bendigo and their processes for managing, but kind of drawing on your global experience, can you kind of give us an insight on how banks and institutions can kind of strengthen their liquidity management frameworks to kind of be able to deal with some of the increasing challenges?
Yeah, so I think quite a lot of the strengthening aspects Amber and Dave have touched on in some way, shape, or form. So the usual suspects are making sure you've done appropriate stress testing and scenario analysis and have awareness of where risk manifests, and then of course having a plan, whether it be diversifying your liquid stack for different currencies as and when they're needed in different time zones and etc. And then also the funding aspect and making sure that you continue to stagger maturities and sources of funding as and when you can. I might offer a slightly different angle though, so that there is that funding and funding liquidity, and then I guess sector type analysis of your banking book as well, just to make sure that you don't have specific kind of geographical concentration. But there's another angle to be taken, right? And that's one of operational resilience. So to what extent does operational risk in and of itself lead to translate into liquidity risk, and to what extent does it exacerbate a liquidity risk event as and when it manifests? And prompting questions which might be asked, especially in a geopolitical context, is to what extent is do you rely on a globally diverse workforce, right? And to what extent do you rely on this globally diverse workforce to produce your liquidity MI? And to what extent do you rely on this globally diverse workforce to activate those contingent activities as and when they're required, right? Another aspect may be to what extent do you rely on third-party vendors and solutions and infrastructure to once again produce metrics that you need as and when is required and when there is a thirst for information? And to what extent do you rely on those vendors, infrastructure, platforms, etc., to respond to a liquidity event? And I guess the other aspect which might be considered is what level of operational capacity do you have within your teams, right? So to what degree do you have key personnel that you rely on? To what extent, you may be able to operate and churn out your MI and respond in an effective manner in a BAU type environment. But when something happens, something unexpected happens and you have to ramp up, do you as an organization have that capacity? Can you switch pace quickly enough to be able to respond in an effective manner? Is another thing which I think is worth considering.
Well, thank you, Ian. And I think in some ways that provides a nice little pivot point to my next set of questions, which might be a little bit more about the future of liquidity management, where things might be going there. I just would like to remind our participant or our viewers if you do have any questions, feel free to add them in the Q&A tab, and we will likely have an opportunity to come back to them a little bit later. So if there is anything you would like to ask our panel of experts, please feel free to pop it in there. But I suppose taking advantage of that opportunity to kind of talk about the future of liquidity management, I suppose I might start with you, Amber, and just say, how do you envisage the role of liquidity management evolving over the coming years? What do you think you'll see, and what do you kind of want to see about how it will evolve? And I might come to everybody in the panel on this, but certainly, Amber, to start with you.
Thank you, Craig. So there's four key things I wanted to talk through here. Well, firstly, we are seeing the customer market preferences are changing to that digital money and how fast that can be transferred around the system. So how we will respond to that, and what also we'll see come through in the regular or the review of APS 210. But we're actively monitoring the balance sheet flows, and we've built stress scenarios around those and adapting to those changing customer preferences. So we will see more in that space. We'll also see more development of new products, the usage potentially of cryptocurrency as funding vehicles, and further growth into sustainable financing. Just on Bendigo, whilst not new products since I've joined about 4 years ago, we've issued our first ever covered bond, both in the Australian and European market, and we've additionally launched a convertible term deposit product. So we're continuing to look for alternative sources of funding. Then the third thing I wanted to talk around was LCR and NSFR. So the introduction of those, as I talked around earlier, for 10 and 7 years ago, has improved investor confidence because they do provide clear and internationally comparable measures of liquidity risk for banks. And all banks, on the back of this, we now need to hold liquidity buffers to meet short-term obligations during a stress. However, the usability of those buffers and how LCR operates during a stress is still unclear, not just in the Australian geography, but across the market. And given the focus of these metrics by investors, many banks are discouraged to use them, where it would result in the LCR falling below peers or under 100%. So as I mentioned, it's not just an Australian issue, but what we'd be looking for is more guidance and market signaling on when those buffers can be used. And the same conversations are happening in the global arena as also in Australia in that space. And then the fourth thing I wanted to talk around was last week, the Council of Financial Regulators, they put a review into the small and medium banks with the ACCC, and a couple of the outcomes there we're supportive of. One was recommending that covered bonds can be used as HQLA, and we are supportive of that at Bendigo, and also increasing, it's an 8% limit on covered bonds up to 12%. So there are a couple of additional changes as well that we're supportive of going through.
Thank you very much, Amber. David, turning to you, how are you kind of seeing things evolving, and what do you want to see going forward?
Yeah, apologies for dropping off there, Craig, as well. I think certainly, and Amber said, her first one is very much resonates with me around the global payment system increasingly becoming a 24/7 payment channel. I mean, clearly in Australia, we've had the MPP and the new payments system for some time now, which has been very successful for small, effectively retail customers. I think increasingly, however, those kind of channels and those rails will be used and want to be used by more corporates and wholesale flows. And certainly, there's been a global push for cross-border payments. From a global sense. So liquidity management practices need to adopt to this kind of new environment in which 24/7 payments can happen and at size and the speed in which it happens. We talked about that before around positioning cash in the right place, but money markets, effectively they're not working on a Saturday and Sunday. So I think between banks and a global model between banks and central banks will need to kind of come up with solutions about how they can actually deal with liquidity and potentially liquidity runs that happen outside of core business hours. Some solutions that have been proposed for that is certainly about pre-positioning of banks' collateral at central banks and making sure that banks can borrow quickly if they need to from central banks. And potentially leveraging some newer technologies that we've heard. So, blockchain is clearly a big buzzword, atomic settlement and how settlements can happen from a global sense instantly will actually come to the forefront. I think there's lots of different people moving in these channels, but until we have a little bit of a central bank guidance about what systems they want to use and how that can work, I think it's going to take a few more, a bit longer than maybe banks would like to see. So being very encouraging for kind of a global push around using technology and recognizing that if customers do want to make 24/7 payments, then banks and central banks need to respond to that as well. AI would also have a large part, again, is a big buzzword, but it's certainly a big push at CBA in many parts of our organisation, and that's true of Treasury as much as anywhere else. We certainly think that AI will have a plot to play at understanding and helping us monitoring our trends of liquidity, understanding where positions and trap liquidity might come from, and help us predict about where to put our cash and how much cash we need at certain parts of the year or through the cycle. EWIs and monitoring for us and actually having eyes on screen is effectively what AI would be particularly useful to give us really early warnings and predictions of about when we can see liquidity stresses that we may not be able to see ourselves in our data. And that's true of. And secondly, Amber mentioned APS 210 changes and the like. I think APS 210 was very much written around that 30-day measure that the LCR really focuses on, although the NSFR is longer, but really less of an issue for most Australian banks. And I think we recognise now that that's only one set of liquidity metrics we can. And I think over time, but with us and APRA and the banks have understood that we do need more protracted stress testing and looking what the world looks like outside of those first 30 days. So it'd be interesting to see what APS 210 does look to and change to come to, but we very much see that as not transformational necessarily, but very much kind of an addition to the quality of the standard as it is today.
Well, thanks very much, David. You touched on AI, and I might come back to that in a moment. But Ian, just to give you the opportunity to kind of talk about how you see things evolving and what you'd hope to see coming in the near term.
So Amber and Dave have stolen my thunder a little bit, but I'll give a slightly different perspective. So I guess some of the themes which come, some of the flavor which is coming through in some of the stuff that Amber and Dave have spoken about is one thing that I touch on is just the pace of the world is just increasing, right? We talked about 24/7 payment options. We talked about digitalization of banking. We didn't talk about social media and the impact that has, but the flow of information, the pace of the world is just increasing, and I guess that 30-day time frame from a liquidity perspective, which is built in as an assumption to more traditional metrics like LCR, I think will be called to question. Now, LCR and NSFR have their purpose in the world, especially in terms of ensuring that there's comparability in terms of liquidity levels in the banks. And I think it will continue to play a role in some way, shape, or form moving forward. The jury is still out in terms of what policy will look like in the coming 5 to 10 years. And whilst we'll wait for BCBS and global regulators to set the tone on what the direction of travel is, I think we can take some hints from what has been released into the public domain and what tactical measures have been taken by OSFI and FINMA and the PRA and so on and so forth. And I suspect, I could be wrong. I suspect that the emphasis isn't going to be on creating more stringent assumptions within LCR and NSFR, more traditional liquidity metrics. I suspect that that the answer will not be in making banks hold larger liquidity buffers. I suspect that the response is going to be one which is slightly more nuanced and one which is focused on number one, vigilance, and number two, preparedness. And what I mean from vigilance perspective, we've touched on this several times in this conversation, but vigilance will be around, look, really pinpointing where liquidity risk can manifest, and also how it translates into idiosyncrasies which exist within your organization specifically, and how you're going to address that, right? So that vigilance in that respect, vigilance in another respect, which is what role do supervisors as ongoing monitoring play in liquidity moving forwards? And how do we ensure, just given the pace of how things are happening, that monitoring and supervision is done in a more real-time manner, rather than kind of waiting on a once monthly or once quarterly basis to be able to crunch numbers and work out if something is untoward is happening. And in fact, we've seen in certain jurisdictions abroad that the frequency of that reporting and that availability and richness of that data, which is made available to the regulators, is in some ways much more demanding than we see here in Australia. So that's the vigilance aspect. And then from a preparedness aspect, it's to some degree it's some of the stuff that we've already spoken about today, which is are you ready operationally to ramp up as and when these events occur? Have you tried and tested your processes for drawing down on or taking those contingency actions or drawing down on emergency funding as and when it's required? And have we done enough as an industry to make sure that the stigma associated with tapping into those liquidity buffers and drawing on those facilities is removed, and that people just do what they need to do when they need to do them? And also, can we produce timely, relevant information as and when something unexpected happens, which we hadn't anticipated, and can we cut that and interpret that in a meaningful way? I think those are going to be things to look out for in upcoming policy change.
Thank you very much, Ian. David, you touched on AI earlier in your answer, and you mentioned the word buzzwords in the sense that you can't really have a discussion about anything these days without touching on AI. So I think we'll incorporate that here, and I might just ask Amber, because David kind of touched on how CBA are thinking about it, but how is AI and other forms of technological change affecting how you think about your bank's liquidity management?
Thanks, Craig. So AI does have a huge potential for us, and we believe in the potential, and we're looking at it with an eager and a curious, open mind. In my personal view, I think it will be a force multiplier of efficiency. We are playing around with AI to determine how it can be used to improve analytics, to deliver insights that we don't get today, and also to increase productivity. We do want to be on the front foot to make the most of the opportunity But just given the size of our organisation and our investment wallet, will likely be more of a fast follower than a leader in this space, but absolutely looking at it with a curious and open mind.
No, thank you very much, Amber. Well, I think I might, David, unless there was anything you wanted to add about how CBA is thinking about it, I'll just give you an opportunity.
No, similarly, Craig. I don't think we haven't landed on our solution for that. And again, I think that the market's moving. Sorry, that space is moving very quickly. But I think there will be some in-house positions, but likewise, I think there are some global third parties that are increasingly interested in helping banks. Not for free, clearly, but helping banks with their liquidity and their liquidity monitoring and the like. So it will be interesting to see, which ones kind of, come to the forefront over time.
Apropos of nothing, I might ask Ian a quick question then, just about, you've got global experience, and PwC obviously as operations across the world. I mean, is there a kind of global best practice evolving for usage of technology and liquidity management, and is there anything that you could speak to about that?
Yeah, there's a little bit of I guess we're still to some degree in discovery stage as to what this thing is actually capable. This AI thing is actually capable of, right? What I can say is, in more recent years, we've seen some investments in liquidity risk technology and capability in order to reduce the latency with which data is available and to improve the granularity of the data which is available. And that's mainly in relation to addressing those types of, the direction of travel type messaging that I provided earlier around, increased vigilance and preparedness for what may come, and that direction of travel. These investments have been in relation to addressing those types of concerns. Now, notwithstanding that, what these organizations have done at the same time as they are making these investments in improvements in latency and in granularity is they're basically asking themselves appropriately, what do I need to do to improve the transparency and visibility of the data to an AI as and when it is plugged into my system? And can it join the dots, right? Does it have the metadata available to basically go, this element means this to another element, and this is how it's connected and how it rolls up? And that's going to be important for two reasons, right? The two things that I can see the AI being particularly relevant to in this particular space is, number one is, can you delegate the 5 whys to it? Why has my liquidity metric moved in this way? It's because of this change in my portfolio. Why has this change in my portfolio occurred in this way? Or because my customer base is slightly altered. Why is my customer base altered? So on and so forth. So you want to be able to provide it visibility of the data to be able to perform that interpretation on your behalf and at pace, rather than relying on someone to dig through reams of data to be able to provide those answers. The second thing that logically speaking, as someone who is not an expert on AI, but which I can see happening in the future, is that vigilance aspect that I mentioned earlier, that ability to monitor on an ongoing basis and to allow AI to work in an, I guess, agentic way, and to self-identify when things are looking slightly odd and to flag that there may be cause for concern. That's another aspect that you're going to be needed to do potentially, and it needs to be able to look through data. And if you limit the amount of data that it can look through and the way in which it interprets the data, you're going to severely limit the abilities and efficiencies and insights that you're going to get from it. You're going to get less out of it.
Well, thank you so much, Ian. So I see we have about 10 minutes left, and I'm also delighted to say that some questions have been coming through on the Q&A tab, so we might turn to some of those now. And look, I'll put these to the panel, and whomsoever would feel best placed to speak, please feel free to. But the first question is from Inga Bambalate Saliba, who asked, what is your assessment of the risk of deposit outflow to stable coins, noting the growing legislative clarity and use cases that for stable coins that are occurring in UK, Singapore, Hong Kong, EU, and their global nature. I suppose in some ways been remiss of me not to ask about stable coins ahead of here, but is there anyone here who has kind of an assessment on what the risk to deposit outflow is going to happen because of stable coins? Big topic, but happy to hear anything you might want to say there.
Craig, I would say that again, we are watching stablecoin. I think that we kind of clearly, there was probably 2 years ago or 18 months ago, there was a big push to stablecoin generally. And I think we saw some collapses of one or two of the stablecoins at that point in time. So it does seem it's slowed down a little bit. I think clearly central banks' interest in stablecoins and a central backed stablecoin. I appreciate that's somewhat of an oxymoron to the extent that central banks are involved in that technology, but using that technology for central banks is something that we're interested with. We've worked with the RBA on a number of projects on that to date, and we'll continue to do that. So I think that I don't know if I'm answering the question directly, but what I'm certainly saying is I think that that it's interesting to see that central banks do recognise the value of that technology, and that a lot of people still like the stability that comes by a currency which does have some stability in terms of actual central bank support. So I do think that's interesting, and the technology is being played with between banks and the central banks.
Thanks very much, David. Amber or Ian, was there anything you wanted to add? Or
I was going to say you answered that very well, David. I think if we just go back to what I talked to around at the start of the session, it doesn't change the principles of how we're managing liquidity risk management. We're monitoring our portfolio, monitoring our deposit base, our balance sheet, setting up the funding plan. And if we were to see something and a large outflow, that's when we would respond, as well as monitoring what is occurring in industry and with the stable coins. But at this stage, there's nothing. Just watching brief versus seeing any specific deposit outflow into the stable coins.
Thanks. Another question's come from Alex Liu, or a couple of questions here. First one, what is the most effective early warning metric that you've found beyond the regulatory minimum? And the second one is, how do you think about the interaction between your LCR, your NSFR, and profitability when allocating funding? So I don't know if either of those tickled your fancy, but please feel free.
Amber, did you want to go first on that, or do you want me to go?
I was going to dob you in, Amber. David went first last time.
Because I let you go first last time. We have a range of. I'm going to start with the early warning metric question. We have a range of early warning metrics that we're monitoring. I wouldn't say I have a top one that we're looking at, but we look at items. We have the LCR, NSFR, a range of how we're comparing and our pricing in the market, deposit outflows. We're also monitoring media. So there's not one that jumps out as the best. It's looking at all of them, and are you seeing trends by one or two or even more of them are flagging during time? And every year, I mentioned at the start that every year we review them, and one of the things we do to review them is has the bell gone off too many times or not enough times given what has occurred in the financial markets over the past 12 months? And that's how we will look at them to, have we got the thresholds of those early warning indicators set right? They're setting off too frequently or not enough. And then coming back to the second question, which was around how do we think about LCR and NSFR when allocating? Was it around allocating funding and profitability? Yeah. So we have to be able to fund the bank in the most efficient way in the realms of our risk appetite. So it is really that balancing, a strategic balance around, if you hold too many liquids, it's not profitable. If you hold enough, you're not within risk appetite. So using the stress test results to set risk appetite, and then managing the funding in the most cost-effective way to ensure that we are within the realms of our risk appetite over the annual or 3-yearly cycle. And when we're setting that funding plan, we look at has our funding plan met our risk appetite across all of our specific metrics, LCR, NSFR, survival horizon, and now we've even added some stress test metrics in there as well.
Thank you.
Yeah,
Dave.
again, I actually think that's a fantastic answer from Amber, and probably more eloquently than I could have put it. But that's certainly true for CBA in exactly what she said there. So, we have a series, without repeating it, but it's effectively the same for us. We have a series of EWIs, early warning indicators, and I think it's important to recognise that they should go amber. They should point out when there is, they're not flags. They're flags to give you that early warning that something unusual is happening. You shouldn't, organisations shouldn't be aware that if they do have EWIs that are flagging, that's exactly their intention. And they're supposed to kind of make sure that you're asking questions about what's happening in your balance sheet, and are you aware and are you comfortable that that's happening. So I agree that there's not one single one. I think they work in tandem, and they look at different parts of the balance sheet and different parts of outflows, inflows, or economic activity, which may indicate that there's something troubling ahead. Not always, and they do. Some days they flag and sometimes they don't, but they are used at all levels of our organisation, and do get visibility all the way at the highest levels as well. And likewise, HQLAs are, it's an insurance policy. Effectively, that's what the LCR is. We hold liquid assets against a potential runoff that may come from our customers. And that isn't from an economics point of view, or from a bank profitability point of view, isn't the best return. When of funding, when you're a bank that needs to raise funding to meet our balance sheet needs. So it is a game, and it does go, as Amber correctly says, that's a board appetite statement that's required under APS 210 about the liquidity appetite for the group and where we sit. And I'm sure organisations would have an LCR kind of target range, and that very much is dictated by their balance sheet appetite directed by their board.
Well, thank you very much. Might go to Ian first on this one, just because left out. The next question is from Phil Jones. Given the reduction in ESA balances and bond portfolios increasing, do you see a risk in systemic liquidity crises by relying on repo facilities to supply short-term cash? So, happy for anyone to answer, but I might start off with Ian.
Yeah, I might give Amber and Dave an opportunity to respond to this one, just given they're closer to the practitioner side of things. Yeah.
And you're probably a bit closer than me in the current role, David.
I'll take that one. Yeah, look, I think QT is an interesting point of view. We've definitely seen, the system globally full of cash as a vote, post COVID, and that is slowly diminishing. And it's pleasing to see that central banks have effectively recognised that. Like I said earlier in my discussions, that banks have got increasingly happy holding cash as a true liquid asset, what it is. So the way that central banks have moved to an ample supply of cash into the system, and the RBA have done that, and that's consistent with central banks globally. It's interesting that the system will find its correct level of where the bank system needs to be. That's not a job that the RBA will force upon banks. Opening repos and repo facilities at central banks, does that open too much risk? I don't know. I think it's just necessary, given this whole hour that we've spent just discussing effectively the volatility and increasing volatility and velocity in which that liquidity risk can come. So I'm actually very supportive that banks and central banks recognise that they have a key play to play in that. It's banks can do what they can, but it's difficult if the runs that we've seen, do eventuate. Hopefully not in Australia, but again, that we've seen post SPV.
Well, thank you, David. Unfortunately, I was just about to ask Dave Cartwright's question about Amber giving a opportunity to describe the nature of convertible term deposits, but unfortunately, I think I might have just run out. So I don't know if that's good news or bad news for you, Amber, but unfortunately, we've just hit 3. So I must, on behalf of the ABA and our members, Ian, Amber, David, look, I want to thank you so much for sharing your insights today. It was very much appreciated. I know I can speak on behalf of everyone who attended on for that. And just a quick reminder to everyone else, a reminder of upcoming ABA events, including our economics and future of banking webinars. Please keep an eye out for the weekly alert, or please visit the ABA website and members portal for more information. But with that, I want to thank everybody for their time, and once again, particularly wanted to thank Ian, Amber, and David for their fantastic insights today.
Thank you so much.
Thank you.
Run back.